The biggest thing in the world of lavender war right now is AI. And I hope everybody just thinks, oh gosh, he's going to talk about AI. Not again. And quite candidly, that's part of how we got to this panel today. So I'm going to say, or has anybody not received some type of panel invitation or session, come to our AI? You know, learn all about AI. Haven't ever seen any advertisement, someone saying, come learn about AI. Alden said something a few months ago that I'm going to underscore based on what we're experiencing. He said, you know, it is the most overhyped thing I've ever experienced. That based on what we're already discovering is the most underhyped thing I've ever experienced. But here's the problem. We've been to a few of those trainings or sessions, and it's kind of like hooking up with Benjamin Franklin right after the whole kite thing, and he's telling you about electricity. And he just talks about that electricity over and over, and it's like, yeah, what do I do with it though? Tell me something. Every experience we've had has been, AI is great, it's so powerful, it does all these things. What does it do? Show us something. Tell me how I can use it. But I want to encourage y'all not to lose sight of what's going on in the world. And here's a couple of, maybe, plant some seeds, a little food for thought. Dionysius Lardner. He was the 19th century lecturer and writer who was the head of the Royal Society of Ireland. So he's the top scientist in all of Ireland. He warned all of mankind just following the rollout of the steam locomotive. You will die of asphyxiation. Humans cannot tolerate traveling at speeds more than 30 miles per hour. Keep your head on a swivel. There's a lot going on. Don't write off the AI just because you haven't figured out what to do with it yet. Today's panel has nothing to do with AI, with a twist. I'm going to sit over here. When we leave, most of you will have listened, thought, pondered, tucked away a few takeaways. As I listen, when I hear those insights, I'm immediately putting it into my workflow. I have several deal opportunities that as I hear these experts talk about what they know, their life's experience, what to watch for, what to look for, what's good, what's bad, what's a red flag, what's a golden opportunity. As I hear all those nuggets, I'm going to codify it. I won't have to wonder in a few years if I can still remember, well, what was it Eduardo said? What were the details of that? How did you apply that? As it's unfolding, I'm coding. I'm actually going to be working through the process of the superhuman power you can gain from AI live and on the spot. It's just a matter of having the creativity to see the opportunity in your daily life, your professional life. Where do I plug this in? What can I do with it? How do I harness it? So keep looking. And stop going to those sessions where it's like, we're going to talk about it. Go to one that says, you're in our industry, you're an engineer, a chemist, a doctor. We'll show you what to do with it. Here are some ways you can change what you're doing. My business partner is Alden Moore. Y'all saw him on the stage earlier. His picture still looks like him. Mine does not.
Also generated by AI.
Yes, both of them, of course, generated by AI. What can you not say about Alden? Wish I would have found him sooner, or he would have found me. He's going to lead this panel discussion today. If any of you have attended one of our panels before, you know that he has the unique ability to combine his own innate knowledge about how the world works, how business works, and marry that into what our panelists are discussing. So help me welcome Alden Moore, and he will get us started.
Thank you, Michael, and thank you everyone for joining us here today. I think it's going to be a really interesting discussion as we dive into the world of private deals, alternative investments, really anything where you can place money outside of traditional public markets, stocks, and bonds. This is, if you'll excuse a little bit of a long introduction, this topic came about from a rapidly growing number of questions and interests that we fielded and activities that have been generated around us and our firm about this space, be it people who are seeking diversification, people who are worried about an AI bubble in the public markets, or people who are seeing a lot of deals but don't know how to respond to them or evaluate them with confidence. And for that reason, we pulled this panel together. So we have, I won't go through extensive bios, but I'll list a couple of things really quickly. So the people to my left here represent hundreds of millions of dollars placed into alternative investments across venture capital, private equity, energy, oil and gas, and real estate. So Eduardo here will be discussing primarily operating company investments, venture capital, private equity, and a little exciting subset that he focuses on in particular with search funds, so we'll dive into that. Sam will be discussing real estate, private equity, and then Richard here is an experienced operator in the upstream oil and gas space, and will be bringing a lot of experience and activity in that. My goal for this panel is a quick survey of these opportunities. Every one of them is an entire career, so we won't even get close to touching the level of depth that would be required to bring one of these deals to fruition. But my goal is that everyone walks away with a set of vocabularies and frameworks that allow you to ask the right questions, talk to the right people, seek the right deals, and understand which ones are worth pursuing in greater detail, which ones are worth bringing to those experts to potentially make an investment decision. So with that said, let me just start by please join me in welcoming our wonderful panel. We're going to start with just a quick deep dive across the primary asset classes. So Sam, I want to start with you and real estate. That's maybe one of the more familiar amongst our group, just because it's something that we see every day, and elements of it are maybe the most accessible. With that said, can you just give us a quick overview when we say real estate private equity or real estate investment? Can you give us an overview of the sub-markets or types within that? What kind of trends you're seeing, and some of the vocabulary that you might expect to see to understand an OIN.
Yeah, absolutely. Thank you all for being here. So real estate, as you can see, I'm the only one up here without notes, so I think real estate is probably the most straightforward investment vertical inside of the alternative space. There's various types of risk levels in real estate. You have value add, opportunistic, and core plus. As you get more into the core space, these are investors that are seeking kind of lower returns at lower risk. I think at the end of the day, real estate, all it boils down to is how you're buying it and how you plan to operate it, like most of the other alternative investments. But I think basis on real estate is probably the most paramount piece of it, whether you're buying an office building, a multifamily apartment complex, a retail strip center, a manufactured housing asset, or even a data center. If you overpay for an asset, you're never going to be able to cash flow your way out of it. And if you're waiting, especially in a market like this, which we can dive into later, when debt is kind of all over the place, you don't allow enough time for cap rates to compress and really to realize value. So,
just diving into a couple of points there. One thing that was mentioned just right at the end, the idea of a cap rate. Could you break down what a cap rate is when you hear that term, capitalization rate? What is that calculating? What does that percentage mean specifically? And what kind of ranges might you look for in different types of deals?
Yeah, product type is very important when it comes to cap rates. I mean, I think most people in COVID, as an example for multifamily, you saw 3 and 4 caps, which now is crazy if you're paying that. In office during COVID, on the other end of the spectrum, you saw 12 to 20% cap rates. At the end of the day, the cap rate is really determining what the cash flow is worth to you for the risk level that you're willing to take. That's not the perfect definition, but for all intents and purposes, the lower the cap rate you're taking on the buy, there's inherently less risk, and that's what you're saying. If you can buy something at a high cap rate and sell it for a low cap rate, that's the most juice that you're going to get, the most profit that the GPs and the LPs are going to get.
Perfect, thank you. Yeah, I think a lot of business owners in the room might be familiar with the idea of multiples on earnings or multiples on EBITDA. My company's worth 4x, 5x, 10x. Interestingly, when you flip over to the real estate side, that same conversation happens, but they just invert the multiples into a fraction or a percent, and it's almost the same thing. So taking net operating income, you could multiply it by 5, or the equivalent would be a 25% cap or 25 cap. So when you hear like a 10 cap, that's effectively a 10x multiple on earnings. And so I think it's oriented that way in real estate. Sam, I'd love to hear your thoughts on this. It's just a deep dive and theoretical, but my sense is it's oriented that way in real estate. One, because it tends to be a very debt-heavy orientation, and so it's easy to compare to the bank rate that you're financing it with to see if there's positive yield there, i.e. you're getting a better cap rate than the debt that you're bringing to the table, so just kind of automatic cash flow. But two, I think it's an easy way to estimate your return, and that's kind of what Sam was speaking to there. In an all-cash deal, what that would translate to is if I bought something for $1 million in all cash, I would expect on a 5 cap, I would expect a 5% return on that investment. That's basically what it's saying. It's an implied IRR. Now, generally, real estate has a lot of debt elements to it that will hopefully increase that pretty significantly. But that's something that I've heard a lot of confusion about, or a lot of misunderstanding, because that's a very common term. 3 cap, 4 cap, 5, 10, 12 cap, and what that means specifically. While we're talking about vocabulary, Sam, could you walk through how, just from a legal standpoint, entity standpoint, and then ultimately the flow of funds, how a traditional apartment complex or office complex might be structured in an acquisition standpoint? Promote, GP, LP, what do all those terms mean? Normal fee structures, that kind of thing. Just when someone's looking at a deal, what's relatively normal? Or if someone's putting a deal together, what would you expect to see?
Legal structure-wise, I think everything, attorneys can argue about that all day long, as they tend to do. So there's 5 or 6 different ways that you can set that up, but at the end of the day, the structure that really matters comes down to the debt, the amount of debt that you're going to take out on the terms that you're able to achieve, a lender willing to lend you. I think the most basic example is on an acquisition deal, like let's say we're buying this room. If it's $10 million, I can get a bank to lend us $6 million. That means we've got $4 million of equity to raise. The typical split between the debt and the equity is a GP, which is the sponsor, which is what I do, and the LPs, which are the investors that are passive, have inherently less risk, less exposure. Really, they write a check, they get the reports, they ask us any questions they want along the way, and we keep them updated. But they're sitting there, waiting for the email that we're sending them back money, whether that's a monthly, quarterly distribution, whether it's a refinance where we're taking the original lender out and returning a large chunk of cash back to the investors, or if it's an outright sale. So we have the debt at the top. That's the least risky capital in the deal. They're the first ones to get paid. And then at the bottom, we have the GP, which is the first equity in and the last cash out. In between the GP equity and the debt is the LP equity, which is the safest equity in the deal. And there's a bunch of other complicated spin-offs of different kinds of debt, different types of equity that we won't get into. But at the end of the day, it's usually a 90-10 split. What that means is me and my partners will invest 10% as the GP of the equity, and our LPs will invest or contribute 90% of the equity. On larger deals, you see anywhere from 2 to 5% of the co-invest, which is a synonym for the GP equity. On smaller deals, I would say it has to be somewhere between 5 to 20%. Most people arrive at a 10%, kind of happy medium. But the reason that is if you're an investor out there and you're looking at a deal of mine or just a real estate deal in general, you want to know that I have skin in the game, and that skin is the most risky there. So if I don't perform for you and you lose all your money, I lose my reputation and my money. So I think when you have misalignment between GPs and LPs, where if you're putting in 3.9 million as TLP and the sponsor's only got 100,000 in total, you feel very differently about that versus $1 million of the GP's money and $3 million of the LP's money.
Speaking of structuring it to align incentives, what are some other ways that a GP might be paid or compensated to further align those incentives with the investors?
So there's 2 or 3 different fees that occur on a real estate deal. There's the property management fee, which typically the GPs aren't getting. There's a third-party property manager that manages most assets, whether that's office or multifamily, really any. But those are kind of more boots on the ground intensive management structures. That's anywhere from 3 to 5% of the NOI. There's an asset management fee which goes to the GPs. That's usually, people can tie that to effective gross revenue. People can tie that to equity, but typically anything above a point or a point and a half on equity is pretty rich. That just means that the GPs recouping that cash they're putting in the deal faster. And then whether it's an acquisition or a development deal, you have either an acquisition fee or a development fee. And those kind of range. I think the most typical development fee is anywhere from 4 to 5% of the total cost of the project. Some people peg it on hard costs, some people peg it on soft costs. If it's a bigger deal. And then on the acquisition side, people can either take their fee based on the purchase price or the total capitalization of the deal. I think purchase price is probably more in tandem with what investors want to see and is probably the best alignment there. And that ranges from 1 to 3% of the purchase price. I think the most important thing to look at though when you're looking at the fees, so long as they're staying within kind of those ranges that I gave, you want to know, like if I'm buying this room and it's $10 million, my fee's $1 million, and my co-invest $1 million, I've got net zero in the game. Because the day we buy the deal, I get $1 million back. Yeah, I had to come up with $1 million to wire in before we close, but that kind of defeats the purpose of skin in the game. So I think making sure that the fee dollar amount is different and gives you enough comfort on what that looks like between what the GP is actually putting into the deal versus what they're getting the day that they buy it before they've even implemented the business plan or put a pen to paper on executing strategy.
Very interesting. Absolutely. Great. Good little takeaway there. One of the things that I think is a large component of the negotiation, of the structure, and of the incentive structure is this idea of carried interest or promote. Could you describe what you or I might call a equity waterfall or a scaled promote? What are some typical levels and percentages that you might expect in a promote structure, and what does promote even mean?
Yeah,
or promote, as your father.
Yeah, my father-in-law calls it the promote. Still doesn't understand what I do, I don't think. So the reason that investors are interested and that sponsors go through the brain damage of operating a deal and getting phone calls at 2 in the morning for flooded pipes or dealing with eviction notices for unpaid rent, all that sort of stuff that the GP deals with. The only reason we do that is for the potential upside in our belief in the deal and the strategy that we have for that specific asset. So once capital starts flowing to close the deal, it flows into the waterfall. I think typical structure is an 8% pref, which is a preferred return to the LPs. All that means is the first 8% of capital goes straight to the LPs. They also get their return on capital, and then it flows into the waterfall. There's all sorts of different structures, all sorts of different waterfalls, but I think the most basic basic waterfall is a 1 or 2 tier waterfall hurdle where the investors get their 8% pref, the GPs get nothing. The split goes from an 8% pref, between an 8% pref and a 15 or 17.5% pref, somewhere in there. The GPs get 25% of that cash flow and the LPs get 75% of that cash flow. And then as an investor in deals that I look at with my buddies that are outside real estate, the thing that I always look at on the last hurdle is it attainable? Is it in line with the underwriting? So if I'm underwriting a 20% IRR, if the waterfall tier is 50-50 after 15, that's a lot of cash on the table that I'm splitting 50-50 for the risk. So it just kind of depends on the deal. But the top tier, the waterfall, you want to see somewhere 50-50 is probably the hardest that you can push, where the GPs are getting half, the LPs are getting half. There's some where it's a lower tier hurdle and it's a 60-40 split where the GPs are getting 40% and the LPs are getting 60%. But the way that all of that, it's funny because all of that ties to an IRR return profile, which ties to cash flow and the time it takes to get your money back. The way that most people look at it is the IRR, most people don't really care much about the IRR. They're much more multiple and yield driven. If you can get a 2x on my money in 3 to 5 years and you get 50% of the profit after you hit a 20% IRR, that seems pretty fair to me. I want to double my money in 3 to 5 years. If you get 50% of the upside and double my money in 6 or 7 years, there's just less money for all of us to be splitting and your multiple is not as good. And you've done 2 or 3 other deals on a 3-year horizon.
Yeah. I think that's a great overview, and what it highlights to me is the degree to which, I think this will be a common theme, I'll go ahead and mention it here and then we'll thread it through the entire conversation, the degree to which you match investments and structures with the job that investment is supposed to do in your portfolio. So one of my goals for all the investors we have here today, and for those who might watch this video later, or if we have some advisors in the room, the individuals that you're advising, is not how to find the perfect deal, but how to construct the best portfolio to achieve your goals. And I think that's exactly what Sam was referring to there. It's people can be kind of tricked into chasing the highest IRR possible or the highest multiple possible without seeking or without understanding how does this fit into my overall goals. Is this a wealth creation play? Is it a cash generation play? And making sure that across your portfolio, you have a good sense of how your overall goals and timing are going to be achieved. I joke with people all the time. They'll come to me with a piece of land or something and say, like, what should I do with it? And we're like, well, what are your goals? And I'm like, well, I want a really good ROI. I want a really good return on my investment. Well, I don't know. Maybe you put a gumball machine on it, and it probably costs you $100. You might get $100 in the same year, and then you sell it get most of your money out. And it's like a 200% return. But it obviously doesn't achieve their goals. They're looking for a certain. And so you dive into that and investigate that within your own portfolio of understanding what this set of alternatives is meant to do. Last question on real estate before we move on to Eduardo. And I think this is maybe the most, I think most notes will be taken here. Sam, you've underwritten, I don't know how many deals, you've seen even more. In just a minute or two, what are the number one things that you're looking for the first time you scan through something? What are the things that make you absolutely pick up the phone and call that sponsor and say, hey, I want to learn more about this? What are the things that go straight in the trash can? And what are other special considerations that anyone in the audience might want to look for?
Yeah, I mean, I think there's really 3 things that matter. It's basis. I think in the world that we live in, there's so much data readily available, and with the relationships that most folks have in the alternative world, for the most part what a good deal or a bad deal is when I'm kind of getting decks and flipping through them. You know, if something traded, I'll use a deal that Alden is actually in with us. We bought a deal off the Dallas North Tollway in 2023. We bought it from a group that had paid almost $60 million in 2017, pre-COVID. It was an office building. In 2023, when we bought it, we paid $22 million. The occupancy had barely moved at all. We were able to distribute 10 to 12% distributions. We started at 10% out of the gate. The asset is now probably worth at least $100 a foot. If we would have paid $100 a foot now, we would have had the cash flow, but when we go to sell it or when we go to refi, there's not a lot more optionality that we have. So I think the biggest thing to look for is to think about what the basis is, and then to kind of back into what the debt looks like. If you can get, you know, if you over lever something and underpay for it at a good basis, I think it may not be the best return that you were hoping for, but I think you're still in the safe zone. If you lever it too much and pay too much, there's no possible way that you can cash flow out of it. You can't just go add on more space to the building because that costs money and you don't have any more money. You can't go get new debt. So I think keeping optionality based on what you're paying for something, whether it's on a per square foot basis, on a cap rate basis, and you're trying to play a spread kind of between the debt and the going in cap rate, I think that's really what it boils down to. And Alden and Michael love when I get them on the phone and talk about some of our deals. You know, I think the best metric is if they're saying that they can sell it on a 6 cap, fully stabilized asset, they've pushed rates, they've spent a bunch of money renovating it or adding amenities that are needed or just simply sprucing it up and putting some lipstick on it. If you can put it on for office, I think a good rule of thumb is if you can put your year 3 or year 5 NOI on a 10% cap and it's still a 2x to the LPs, that feels like a pretty good deal. If you put a 10 cap on it and it's a 1-3, all of a sudden you have to go back and look at all the underwriting that you're doing on how quick you're going to fill vacant spaces, how long you think it's going to take construction to either renovate or add amenity centers or whatever you're doing. And I think that's really what, as an investor, that's kind of the lens that I take. If we're very wrong on our exit assumption, because typically on real estate you can project the cash flow pretty well. Mostly have leases in place for a set period of time. That's not going to change. You may have some defaults here and there that you can throw out on a bad debt expense as a line item, but at the end of the day, if it can cash flow and still be a 2x on some set cap rate that just seems crazy, like I told you and Michael on that deal, if we have to sell this on a 10 cap, we're in the middle of World War III or something terrible is going on.
I think that's perfect, and that's exactly what I was hoping for in this conversation. I can't think of something that's more easily accessible than basis, and you check market comps. It's not, oh gosh, I hope that their occupancy assumptions hit. I hope that their rent growth assumptions hit. Those are huge, move the needle in really material ways. But the idea, and I really appreciate that you can make a lot of your investment decisions, let's not overcomplicate it, based off of did they buy it at the right price or not. And all the other, understand that it's important that ancillary to that, that it can juice it, but it won't create you won't take a bad basis and get a great deal out of it otherwise. So I think that's perfect, and I appreciate that. It looks like we flipped over to Michael's screen here. We went through this a couple of times throughout the presentation. So this is just a quick view of what's going on behind the scenes. He mentioned building that coding software, or that software out of code during this presentation. That's what he's doing here with several notebooks, and I'm sure this is Claude Code developing a tool here to evaluate real estate deals. So that'll be fun. As we continue to go through here, we'll get that updated a number of times, and then I'm sure following the presentation, if you would like, let us know. We can send you whatever the output of this is. Along with, we also built about a 25-page reference guide with all the vocabulary, the frameworks, the entity structures, and that kind of thing that we're going to be discussing today, and the frameworks to compare across asset classes. Again, if you're interested, let us know. We'll send that to you. And before you leave, we have a 4-page version of that. That's just a little cheat sheet. Make sure you collect that on your way out as well. With that said, Eduardo, bring us into the world of investing in operating companies. We're talking private equity funds, we're talking venture capital funds, search funds is an element within that, independent sponsors. You worked in Phil Knight's family office, you've led venture capital firms, worked in private equity firms, MBA at Stanford, master's at Harvard, bringing a lot of experience and education to the table here. First, let's start with just a breakdown of some of the broadest terminologies, because I think colloquially we hear some of these phrases used interchangeably, and I think it's important when you're being approached with the deal to understand what maybe the implied understanding is based off the terms that they're using. So can you break down kind of the world between what people might call venture capital? Really it's all private equity, but if you will say private equity, is there a subset of that they're probably referencing? And then maybe tack on the element at the end because of the speed at which it's growing and your particular interest in it, that is search funds or entrepreneurship through acquisition, give people a sense of what that is and what you look for there.
Yeah, happy to. So at a high level, I break it down into, three categories. You got private equity, which is buying steady companies and trying to grow them. That's private equity. A subset of that, but it's its own category as well, is venture capital. This is high risk, this is like startups, right? So these are the folks that are trying to find the next Facebook. I want to go to $1 billion, I want to go to 0. In private equity, you want to go to 2x, you want to go to 5x. Venture capital is 0 or $1 billion. And the last category is what we call entrepreneurship through acquisition, search funds. It's a form of private equity where you go and find really talented operators, you give them money to go find a company to acquire. So think about it as micro private equity, operator led. Those are kind of the three main categories.
Perfect. Within that, what are some of the common structures that you might see in a couple of areas? Let's start with how these deals are structured, minority investment, majority investment, that kind of thing from the sponsor level and the acquisition of either equity or the company is happening. And then we'll move after that to how the structure is usually organized between the investor and that sponsor, be it a fund or an independent.
Yeah, so in venture capital deals, it's all cash, and you're investing equity into the company to buy a minority portion of it. So
along for the ride.
Along for the ride. A young Mark Zuckerberg comes to you and says, hey, I'll give you 20% of my company, you have no control, but we're going to go to the moon. That's kind of venture capital. In private equity, you're typically, on average, you're buying out the whole company. So it's an owner that's retiring, or maybe just wants to sell the majority of his stake. And so that is usually going to be a mixture of equity and debt. And in the search fund model, it's also going to be equity and debt, but like 80% is going to be equity. So private equity, when it's like a fund that's doing the deal, you can expect a lot of debt on it. But if it's an individual doing the deal, like a search fund, it's going to be much more equity based because it's a little bit riskier.
And now if we move back to the structure of these funds themselves, now we're getting back into the world that we sort of talked about in real estate. Different terminology, maybe you can bridge some of those gaps. I mean, what is a promote equivalent, or what is that called in your world? What does that structure look like in your world? How do the GPs make money? And how are those checks written back out to how and when are those checks usually written back out to the LP, and how and when are the checks written to the underlying companies?
Yeah, so it's maybe the difference is like in real estate, it's much more about free cash flow. It's kind of an income generator, a steady stream of revenue. That is not the case in my world. So you're in it for the long haul. You put in $1. Let's say if you're investing in a fund, like a private equity fund or a capital fund, you put in $1 and you'll get anything back for about 7 to 8 years. Now you might get $10 back though. So it's a longer term hold. It's not about free cash flow. It's not an income generator at all. It is a growth story for the value of whatever you're buying in the underlying companies. That's true for venture capital. It's true for private equity. In venture capital, it's going to be 7+ year hold before you see any money. In private equity, it'll be 3 to 5 at the deal level. So let's say you're investing in a company. If it's a startup, it might be. It took Amazon 11 years to go public, right? So it's not unlikely that you won't see it for a decade plus. But if you're investing directly in the startup, you might get $1,500 back. So the risk reward here is that you're holding it for the long term. In private equity, it's going to be a shorter hold, like 3 to 7 years, and you're expecting $35 back for every dollar you put in. But expect no money in the interim. Expect to get a big check at the end, or no money at all. Or a very sad email, one of the two.
I think that's a good point too. One, it helps fit within that, and I'm developing a portfolio, a diversified portfolio, what job is each investment playing. I think that's also a good clarification, because if you're, say, the private equity world, you're entering into a very cash generative business, maybe a mature business that it does have free cash flow. You might expect for it to play more like real estate, which it can. But I think what you're pointing out is very true in that ideally the sponsor that you're backing has such growth ambitions for it that cash flow is better spent reinvesting in the company or paying down debt to juice that multiple that you're looking for at exit, rather than some kind of real estate distribution. I can't usually pour a lot more money, an almost unlimited amount of money back into my apartment complex and increase the multiple. Maybe I can add some amenities, dig a pool. But with a company,
Yes.
ideally you're buying a competitor, you're growing your sales team. There's an infinite number of ways to expand that exit size and potentially multiple. And so that's one of the reasons I think why, even in a mature business, it most often fits within a wealth creation orientation rather than a cash flow generation orientation. Is that a good kind of understanding?
Yeah, that's exactly right. And to answer your other question around like expectations of who gets paid, if you're backing someone who's an entrepreneur, so a startup, I expect them to have all their skin in the game. So if you're gonna ask for my money and it's so high risk, I expect you to go bankrupt if it fails. That's just a startup game. Like if you're like, well, I want to be a CEO of like 5 different companies, unless you're like, I'm like, wait, why am I giving you money? Why don't I give the money to the person that's actually operating the company? So a startup plan is like an all skill in the game type of situation. And the outcome for them, of course, they own, if not the majority of the company, certainly all the control. Like to this day, Mark Zuckerberg still is the largest single shareholder and also has the most control. You can't fire him, right? So that's why I expect him to go bankrupt or become a billionaire. So a startup plan, it's very binary outcomes they're looking for the company itself and for you personally. In private equity, if you're buying the company, let's say you're an entrepreneur, a social entrepreneur, you want to go buy, you're a great operator, a great GM, you want to go buy a company, and if you're getting the majority of the company, so you say, hey guys, I'm buying a company, at the end of the whole thing, you give me a little money, I'm going to own most of it. Well, I have to go bankrupt if it doesn't work. If it's going to go to, if you're going to own the majority at the end of it, you better have all your skin in the game. There is the kind of independent sponsor model where you say, hey, it's a little bit more like real estate, where you say, I'm going to buy a company, and if we exit for $20 million, my LPs, you guys, my investors will get 80%, and I'll get 20. In that case, okay, you don't have to go bankrupt. So it's a little more evenly split because the risk is more shared. But if you're going to own the majority of it, it's like someone buying a real estate building, and at the end of it, owning like 90% of the equity in the building. It's just not fair to the LPs. So if you're going to go sponsor the deal and own the majority, your skin, all of it needs to be in the game. If not, there's some negotiation available.
That's really interesting, and I think it's a good statement to maybe set expectations or frameworks, especially from the entrepreneur side of the credit that capital expects. Because I think I have a lot of conversation with aspiring entrepreneurs or general managers who, it's my idea, and I'm running it day to day. I should, if I can give them a good 8, 9, 10% return, shouldn't they be happy with that? I'll just buy them out of the company, buy the investors out of the company, after maybe I double their money. And then I'll own everything. It's like, you have to understand the risk that they're taking with their capital and the degree to which it's your idea. It's worth nothing if they don't put money behind it. And capital is expensive because it's high risk capital. And so it's good to understand the expectations that capital has going into an investment.
Yeah, that's exactly right. And it's like, it's very different in real estate. Like, worst case scenario, you still have a building, right? Worst case scenario in my world, you don't have anything. So it can go to zero. Not only is it real fast. Not only is it possible, but 90% of startups go to zero. 90%. And so you want me to get money, I expect a lot of sense of alignment.
I think this will be really interesting because you and I have had this conversation before, and I thought your insights were particularly poignant and more specific than I had expected, and I think the audience will find this really interesting too. When you have invested in a
Sounds like
search,
a hot takes. I'm scared what you're gonna ask.
I know, and Eduardo's full of hot takes. This is great. I can go anywhere. When you have funded a searcher and they're bringing you potential investment opportunities, for anyone who's not, we might cover this in a second, but at the one sentence level, search funds usually work where a young, talented operator, usually coming out of a top business school or something like that, raises their hand and says, I want to buy a business, collects very small checks, $10,000, $20,000 from a variety of funds like Eduardo's or individuals that are basically putting in a call option of if I lose this because you don't find a business to buy, it's not that big of a deal, but it reserves my spot to get an allocation or a look at a deal if you take to that point. So you funded a searcher, they're bringing you a potential acquisition target that they're really excited about. What either advice are you giving to them, or what things are you thinking about in deciding whether or not to take that next step beyond the talent of the searcher, which is non-negotiable? But the business fundamentals themselves, what are you looking for in a business that you might be funding through a searcher?
Yeah, it's a great question. So in the search fund world, we're buying businesses from existing operators. So there's very different startups. Like I would never buy a startup candidly because it's just so high risk. But when we think about search funds and private equity kind of more broadly, these are what I call enduringly profitable businesses. So minimum of $2 million in free cash flow, and ideally they've been doing that for a decade plus. So it's like a very steady, still business that we're buying. We're going to buy a startup because it's like, if a startup really has that much high potential, why would the seller be selling? So it's very rare for a startup to be acquired, a good one. If it's probably the falling knife, right? If the as far as going to $1 billion, but I want to sell it to you, come on guys, it's unlikely. So look at companies that are like, hey, I've been around for 15 years, free cash flow is $2 million. That's kind of what we're talking about. We're talking about buying businesses through search funds. Things that we're looking for. The biggest things would be, remember, it's not the 0 to $1 billion game. So we're looking for companies that have been profitable for at least 5 to 10 years plus, ideally. That's one. 2, non-complex operations. We're putting in a brand new CEO who's never done it before. If it's really complex, that's a dangerous game to play. So we're not looking at anything complex. We're talking about HVAC, we're talking about plumbing, an RIA, things that a very competent person that's doing it for the first time is going to be able to succeed in time. So that's what we're buying. So the lack of complexity is really important for us. 3, it's revenue quality. So if you have to go and get new business every year, like it resets, like it's a project-based business, that's really tough. Because we're not taking out, they're selling, but we're replacing the CEO. This is a CEO that's been doing it for 20 years, and they've been able to produce $10 million of revenue per year. If you're coming in and never had that before, the odds of you hitting that same sales target, if you have to reset sales every year, is really hard. So we don't really do project-based revenue. Like if it's not recurring in nature, the revenue, we probably won't do it. And that's a spectrum. Like you have software where it's a contractually guaranteed revenue. So third thing would be quality of revenue. And the fourth thing, I think that was before, but increasingly it's culture. You can fix a lot of things in a business. You can hire people, you can fire people, you can fix the tech stack, but fixing culture is so hard that it's not a bet I'm willing to take. So when we look at businesses, we want something that's been run well by someone with high integrity. If you're buying a business from someone that has low integrity, no amount of legal defense is going to prepare you for that. Like there's no hedge against someone who is trying to go and start a competitor business after they sell to you, right? So culture is kind of the last thing that I look at and I look at very closely.
That's super interesting. I want to spend just a second diving even maybe deeper into a couple of those points. But first, revenue quality. One term that you had mentioned to me before that I never heard before, but I thought was really interesting and it changed my mindset around this a little bit. You mentioned recurring revenue. Obviously, we're very familiar with that, like a SaaS business. And then you mentioned statistically recurring revenue. Could you give a sense of what that might mean in practice or how to evaluate that in regards to something that you might think of as like, I give you my credit card and it charges every month. Great, perfect recurring revenue. What might you mean with it's functionally recurring or it's statistically recurring?
Yeah, that's great. So it's a spectrum. So the highest quality revenue is revenue that's the same or more every year. the subscription, for example, and it's really hard for them to quit. Like for whatever, maybe it's like a critical software for surgeons. Like they can't do without the software. They're going to re-up year after year. So that's very high quality revenue. Maybe next on the spectrum is things that aren't contractually guaranteed, but as Alden alluded to, they're statistically or actuarially recurring. So for example, a great business in the past couple of years has been, I forget the term for them, but they're med spas, med spas. Well, people don't have to go to a med spa on a subscription. You don't have like a subscription to it. But someone that goes to a med spa goes every year like clockwork. It's just statistically true. So if there's not a contract backing up the recurring nature of that revenue, statistically speaking, it's going to happen. Another one would be like things like it's like a sad business, but like cemeteries or funeral homes. Statistically speaking, you're going to have more of that every year. So although it's not, there's no contract going to say there's going to be another person buying a coffin, you can be statistically sure that that's going to be a need moving forward. So it's kind of a range of how statistical it can be.
Great. And then how would you, the second one, to dive a little bit deeper into that culture element, you mentioned it's so important. The integrity of the founder or seller being one of those elements. How do you assess something like that in a 90-day due diligence period?
Oh, it's so hard. It's so hard. If I knew, if you know, come find me afterwards. Over time, you get to know the seller. You meet them, you meet the team, you walk the building, and you get a sense for, it's like so soft, but it's honest. How much joy there is. If people are happy to be there, it can be a plumbing, it can be a, I went to buy a flower shop in Dallas actually. And everyone there was, they loved their job and they loved their boss. That's a good culture. So there's something soft about it that's hard to spending time
and with the people.
Yeah, but if you want like a secret tip from me, it's a pro tip. If there's an interesting proxy, it's employee benefits. If they have a lot of free cash flow, like it's a very it's a business that's spent out a lot of cash, owners take home like $1 million per year, and there's no employee benefits. In my experience, 8 out of 8 times. Yeah, 8 out of 8 times. It was a toxic culture. The CEO is taking home $2 million per year, and there's no employee benefits. That's a pretty good sign.
That's interesting. That's interesting. And I think I dove so deeply into that element because I hear a lot of experiences or interest in selling a company or buying a company, that kind of thing, be it independent sponsor or be it through a searcher or a self-funded searcher or something like that. Especially around here, there's not a lot of institutional money chasing operating businesses. And so that's what a lot of that deal flow looks like.
Yeah.
Let's shift for just a second before we move to energy, and just new world for me and a lot of people in the room, but for a second, let's shift to what a fund looks like. Investing in a private equity fund or venture capital fund, even though they might not be local, they're certainly accessible to high net worth or ultra high net worth individuals. How would you find one, assess one? What would you expect? What are red flags? How would one go about investing in an institutional element of private equity and fund selection there?
I have so many thoughts on this. So I think I would say, okay, I'll be succinct. If they have had a lot of success doing this before, that's a good sign. It's not a promise of future performance, but if someone's coming to you and they're saying, hey, I want to raise a lot of money to this thing that I've never done, I just wouldn't do it. I put in real estate. Like, there's so many things you can do instead. The risk of that is just don't do it. Just go buy a building and get the rent. Like, just don't do it. If they've never done it before, I just be real.
There are going to be people that have done it.
Two have done it. You can go find someone else. So, if they've done it before, or maybe they have
from an emerging sponsor.
As someone who's never done it before, and it's raising a fund. Or if they have team members that, for example, if you're like, they've done things that would lead you to believe they can do this well. let's say they're investing in life sciences, and they're like an MIT PhD, the most published author on this. Well, maybe they haven't been a CEO founder, but they can diligence technical risk, right? So having deep expertise, I guess, is the main thing I would say. Two, just to give you all like rules of thumb, who else is investing? That's probably the best question. If someone's like, hey, I want to invest in my fund, and then you ask who else is investing, they're like, only like my mom. It's like, okay. But if they're like, oh, well, the endowment of Duke University is an investor. Well, they do like 300 hours of diligence on you. That's a pretty good bet. So having other really credible investors already in the fund will save you just so much work. So one, the credibility and historical expertise of the GP in this case. Two, having other investors in the fund who are, because we're all busy. Why not ride the coattails with someone who's already done the work, that's a full-time job, due diligence, these kinds of funds, right? So if no one is in it, and like you're giving them money, like don't be nervous to ask, hey, I want to know who else is in it, give me the full list, and who is the most institutional firm that's already investing. If they say, well, no one really, that's fine, tell them to come back when someone does. Like, it's your money, like don't be afraid to ask those questions. And then maybe the last one, and this one's really easy, looking online, because like ChatGPT, Claude, they can all do this. Just like either take their documents and upload them on ChatGPT, or take whatever they're saying the terms are, and just ask ChatGPT and Claude, are these market terms for this kind of fund? If they're like way off, Claude will be able to tell you, and just try asking questions if it's off.
Yeah, interesting. All right, now I'm trying to really put my thinking cap on and move to energy, just because I feel like all the terminology is different to talk about the same things. And it's just a space that, although our region and our community is largely built on the back of it, relatively few people understand it and the flow, and particularly, and I think we're going to spend quite a bit of time on this, the areas in which you can invest for a wide range of risk exposure. I think before Richard, you and I were talking about this, and I think a lot of other people think investing in energy privately pretty much means giving someone some money to go drill a hole in the ground. And in our conversation, that's certainly an element, but I think it follows a pretty large spectrum. So maybe I think that will inform a lot of the rest of our conversation. So could you go ahead and give us a framework of how we're going to focus on upstream, because honestly, I feel like if you want to invest in midstream, just go buy like Energy Transfer stock or Kinder Morgan or something. But we'll focus on upstream. But within that, what are areas of the value chain that you can invest? What are some trends, return expectations, risk level, and frankly, just what do each of them mean if someone were to bring a deal to you?
Well, I'm sitting in Tyler, Texas, and the East Texas oil fields a few miles away over here, and there's been so much money made for the last 100 years here. I feel like there's probably someone sitting in the room that knows this topic better than I do, but I'll take a shot at it. So just to break it down, there's a range of types of investment you can make. There's mineral ownership, which is somewhat akin to real estate ownership. In Texas, there's two estates. There's a surface estate and a mineral estate. The mineral estate is actually superior to the surface estate. So there's rights that you can acquire, that you can hold, and they have, sort of intrinsic value. There's speculative leasehold ownership. So you're just either funding or you're buying leases. You're funding a land group to take leases, or you're buying leases that someone has taken in the hope of having someone want to buy those leases from you to drill them. There's entering into an area of mutual interest, a defined plot on the face of the earth that's got a boundary, and you're basically partnering with an operator. So you're becoming a non-operated working interest owner. And then there's
And sorry, in that, it's a plot of empty land and you're hoping that you're operating on it?
No, it could be anything from there's production there and someone's acquired it and you're going to do infill drilling to it has not yet been leased yet and the operator's going to acquire the leases and then drill. But you're working with an operating group that, just as you said, with whether you're talking about the operator level or the funding level, you're working with someone who has a business experience and the staff to go out and take leases and drill those leases. So it's just defining an area that you are partnering with them. The reason that's done is because you could be in the middle of an oil field. There might be things going on there where you may want to do your own thing outside that, or the operator wants to do something else outside there. So they're picking partners for a certain boundary area. Wellbore only, non-operated working interest is something we'll talk about a little bit more, but this is really an area that's developed in the last few years where you can basically step into someone's shoes who has the opportunity to fund a well proposal that's come from an operator, and you can take their place and just provide the funds that they would have provided and take the interest that they would have had in that well. And then there's non-operated working interest in producing property. So an existing well or wells that are in production, and you're basically acquiring their interest. Again, that's a little bit more akin to a real estate deal. So the first one and the last one of these, you're buying something that has some intrinsic value. Either it has some rights that you can hold forever unless you choose to sell them, or you're buying something that has existing cash flow for some purpose. Either you bought it at a really good basis and you feel good about it with the information you have about the cash that's going to come to you, or you bought it because you think there's more work to be done on it. So those are really the most direct connects with what's been spoken of, whether it's another type of operating company or a real estate deal.
That's interesting, and something that comes to mind is you were going through those options, and it's something that really, a thread that weaves through all of our discussions is varying levels of risk, but defining what that is and making sure you're being paid for it. And I think immediately a lot of people think, well, risk, how likely is it that I lose money? And that's certainly an element and something you're ultimately trying to assess, but that might be a challenging thing to assess. So if you're looking for a proxy or what risk might mean in a more financial sense, it's uncertainty. It's how many steps of this process have to go right, or how many opportunities are there to go wrong that creates that opportunity to lose money, and thus need to be paid for upfront. And I think that's a good way to understand risk across asset classes, be it the difference between an occupied apartment complex or a development. There's construction risk, development risk, et cetera, or a private equity deal, venture capital, or across the spectrum of oil and gas investing is how many things could go wrong, or what things are outside of my control, and making sure that you're paid appropriately, because that's a pretty easy thing to gut into. Like, okay, well, they got to drill the well, they got to find someone they got to go get some leases. Well, that's it. That may or may not happen. They got to, have a good operator. That may, so there's the more of those that there are, the higher return you need to demand. When you're talking about buying existing production, you've used a term a number of times in our earlier conversations that's like PV10, PV25. That's something that I haven't heard before outside of energy investing, but it certainly frames cash flow in something that's very common across asset classes and very easy for investors to understand. Can you give a sense of it? It's kind of like cap rate, where it's very intuitive if someone's ever defined it for you. Can you give a sense of how to understand that terminology?
So let's use that in the context of buying existing production. So a reservoir engineer would basically generate a plot and look at the amount of production. Oil and gas wells generally decline, right? So you've got an area under a curve where the vertical axis is the amount of production, and near side of the axis on the X side is today, and out here might be 30 years from today. And so you've got this declining line that is basically the volume of hydrocarbons that you expect to get out of the ground. You're going to match that with some perceived future prices and create a cash flow stream on the revenue side. Then you're going to subtract out your costs that you foresee spending to get that oil and gas not only out of the ground but to sale. And And then there's a line here that says, well, when production declines down to this cost line here, it's no longer economic, right? So you're gonna put a cutoff out here. And so you take that, and that's your future cash flow. So similar to anticipating cash flows from an operating business that might grow or might grow a lot or might grow a little, here, this is the inverse, right? Where it's, you bought a grocery store and you stopped ordering groceries, right? Unless you go and do something new, which is to drill a well or improve the production. So when you do that, then you bring those future cash flows back to present. And so the typical way to discuss this is just say, I would like to buy this at a present value at a 10% discount, a 12% discount, a 15. If you're buying existing production today and it's not desirable for other purposes, that tends to transact at a 15 or 20%. And unless somebody believes that future oil and gas prices are going to be much higher than they are today. And then you start seeing things that the discount be reduced. So that's that idea.
Yeah, it's really very analogous in a lot of ways to cap rate, where PV, present value, 10, would imply, if nothing changed, a 10% return on your investment. 15, a 15% return, 25 to 25% return. If commodity prices stay the same and there are no surprises in the yield or the decline curve, right?
And no different than other areas, when you have a buyer and a seller, the sellers look, their belief in the future cash flows and the future environment could be different than the buyers. And so that you're always probably going to have some conservatism on the buy side, that because you're looking at multiple options to buy things, and you go, well, which is the best for all these reasons? So you may haircut some things more than others.
Yeah. What's when you look across, as much as possible, when you look across the investment types within this space, within oil and gas or energy investing, what are some elements, well, even if they're obvious, what has to go right in order to make a whole lot of money? And what can go wrong, and are there any that are maybe not as intuitive to less seasoned or inexperienced investors that might be red flags or indications of misaligned incentives that they need to make sure to look out for?
So if you think about it, again, there's the opportunity to have the equivalent of a buy and hold with a 5 to 7 to 10 year return. If you're buying into a drilling prospect, it may take 2 years to lease it up. Then there's cash going out the door with multiple cash calls. So this is a little different environment if you're buying in as a working interest owner, because basically you're signing up under this standard form agreement that's been used for many, many years, and capital can get formed very quickly. But what you're doing is buying a fractional share of the production, and you're taking on a fractional share of the expenses. And you will do that every month. You'll get paid your share of production. You'll pay in your costs, your joint interest billings. And so this is one where if there's production in place, you can buy that share and you can start seeing cash come to you, and you hope that that rises over time for some reason, or at least meets your pattern that you expected in order to get the return you hope. On the other hand, if you're buying minerals, the question is, are those producing minerals, or are those minerals that are in an area that you believe will be produced? So you may be buying those for $2,000 an acre, and your idea is that either I'm going to get a royalty check someday and I'm going to get my payback that way, or somebody's going to show up and want to acquire those minerals someday. Right. So the things that can go right and wrong, I mean, the general risk, there's commodity price risk, there's the geologic drilling risk, there's the risk for the operator. If an operator comes into an area and does well or does poorly, that could be for a whole host of reasons, but it could impact your investment. Just the risk of operations, just the things that go wrong, right and wrong as a skilled operator tries to carry out the tasks, right? Liquidity, it's not a liquid investment, and so if you stack those together, even if you think about the impacts You kind of put on a risk-reward scale, I would put mineral ownership, producing non-operated working interest, joining up with an operator to take on a project with them as a working interest partner, buying a wellbore only opportunity where it's a rifle shot to go put money into a single well and see what the results are, but you know that thing's about to be drilled, so there's no time risk. It's just you're stepping into someone's shoes to take the outcome with an operator that you can assess the quality of that operator. Then the highest risk, I think, is speculative leasehold. So you're just out there taking leases with the hope that the money that you pour into that effort is going to be returned to you. And then if, you know, what returns get better, obviously, when more oil and gas is found than was anticipated. That holds true whether you're a mineral owner or a leasehold owner, or you're a direct participant in the project. So if you, and the world has changed, just like has been mentioned before. There's been so much done to take publicly available data and put it into environments now where you can look at a map and see results. And you can see what's going on through interpreting the amount of oil and gas that has been produced across a field. So it's as if you're looking at a live science experiment, and you have a data set in front of you that you can really, know and feel and understand. So finding and development costs could come in below estimates. Commodity prices could rise after the investment's made. Yeah, one thing is getting into an area and learning about it. You may find that your first deal wasn't that great, but just like knowing Dallas or knowing how to spot the culture in a company, you may end up in an area and you have other opportunities emerge where you can acquire either leasehold or operating interests at favorable prices because A, you now understand who's there, B, you understand what favorable prices are, right? So I think the...
sorry to jump in, but there are a couple of elements there that jump out. One, the value of bringing someone into your investment decision that is familiar with the area, both the area of investing and maybe geographical area. Two, a conversation that you and I had the other day that was never something that crossed my mind before, but I think it's great for any potential energy investors to consider, is the possibility of, and the not uncommon practice, that in a single wellbore interest, that an operator might sell a lot of an exploratory well in a new field. If it hits well, and they recoup quite a bit of money on something they didn't put a whole lot into, it's not uncommon for them to drill another well right beside it that they didn't take a lot of investors in and pull out of the same hole in the ground, but own a lot more of that well, and kind of infill that direction. So I think that's something to keep in mind as you think about that spectrum as well, making sure you understand the long-term play. If this goes well, if this goes poorly, and who am I partnering with? We're getting a little bit close to 3 o'clock, and I want to make sure that we leave some time for questions. So I do want to shift to spend just a minute on the idea of portfolio construction and deal sizing. If you're thinking about an allocation to alternatives, how to think about that allocation, how to think about what check sizes make sense for you and your situation. Eduardo, I'll probably lean on you with your family office background for this. But before that, I do just want to hit a couple of quick little statistics or highlights as we think about an allocation toward alternatives that I find fascinating, and I think it highlights the importance of the conversation we're having now, and the idea of portfolio construction is probably the time to mention it. We're entering into a world where I hear all the time on LinkedIn or whatever, this idea of if you put X thousands of dollars into this S&P 500 fund over this period of time, it will be X amount in the future because it's diversified, you're basically betting on the US economy, that kind of way, but you'll have this 8 to 10% growth over time. I think that is underappreciating certain underlying risks that are inherent to earning an 8 to 10% return. You know, I think it's voiced as a guaranteed because you're diversified and you're whatever. And there are some developing elements that I think are worth noting as we discuss this that underscore the importance of an allocation into private markets. One of them is a relatively recent study that came out that noted that across the last 30 years, a majority of public companies, 55% of public companies, failed to earn even treasury bill rates of return. Risk-free, as Perriman said, the global risk-free return, a majority of public company stocks didn't achieve that. Moreover, virtually all, over 90% of the net economic gains in the stock market in the last 30 years were generated by 2% of the public companies. So it would kind of imply that if those 2%, that handful of companies that changed the world, hadn't been based in America, hadn't gone public at the right time, anything, the S&P 500 the last 30 years might have had almost no return based off of whether or not those 2% of companies existed and went public in the United States. I layer on top of that an element of, say we still generate the best companies in the world in the US. It's a good case scenario, a bet on the US. I look at elements where that next generation of drivers, the next Microsoft, Google, Apple, etc., SpaceX is about to go public for $1 trillion valuation. OpenAI is about to go public for a $900 billion to $1 trillion valuation. Anthropic, etc. They all have valuations that are so astronomical. If that is the next generation of the Microsofts, Googles, Apples, if SpaceX were to become a $4 trillion company, which would be currently about the largest company in the world, that only represents a 4 times return to public investors. While an IPO investor in Microsoft might have received, I had the stat at one point, but it was a several hundred thousand times return on their investment. So that means that if that is our generation of next 2% companies, in order for them to carry the weight of that S&P returns, then they would have to become tens of thousands of times more valuable and more powerful than Google, Microsoft, and Apple, which is kind of terrifying. But I think some of those elements are maybe not discussed as much in the public market and underscore the importance of having some allocation in apartment complexes, in these small operated cash flowing businesses, in energy that we're going to need more and more of all the time over the next handful of years. So I just wanted to lay that kind of foundation out there as we discuss alternatives. It's not necessarily some call option that if you just have excess cash and you don't know what to do with it, it's fun because you get to talk about it at cocktail parties. It is maybe increasingly an important or a necessary element of a truly diversified portfolio. Not to mention, the Mag 7 is 35% of the S&P 500, and it's all an AI play. So even the diversification element probably isn't really there. An S&P 500 bet is just an AI bet on 7 companies. So with that, let's transition to what does making that move look like? As you're sitting there, you're thinking, you're talking with your family, your financial advisor, I want to make a move into developing an alternative portfolio. Eduardo, how do we think about check sizes? How do we think about what percentage makes sense? How do we think about the speed at which you try to develop that portfolio? Just give us a sense of if you were managing a family office or your own funds of capital, how do you think about allocating that?
Yeah, it's a great question. At a high level, I would say, I'm going to speak in percentages because that's probably easiest for everyone. if you're someone who has, let's talk about your 100% of your net worth, you as an individual want at most 30% of your portfolio to be in alternatives. For some context, if you look at the best run investment pools in the world, so these are like the Harvard Endowment, these kind of funds that have like literal PhD level people working on portfolio construction, their max about 30 to mid max, like maybe in Yale, 50% of their portfolio is going to be an alternative. So if the PhDs of the world say, hey, that's too much, we should probably be less than that, right? So ceiling for an individual would probably be around 30% of your portfolio max in alternatives, and within that 30%, it should be pre-diversified. As a rule of thumb, I would say no single deal you do should be more than 3 to 5%. It varies per asset class. I'll say if you're doing direct investments in companies like startups, it'd be even less than that, it'd be like maybe 1%. If you're buying, but if you're investing money in a fund, like let's say you're investing in a private equity fund, that fund is going to buy 10 companies, now you're pretty diversified. So maybe instead of 1%, you do 5%. So, but as a general rule, no single one check should be more than 5% of your portfolio, and it's a fund. If it's an individual company or an individual piece of land or an individual oil well, max, between 1 and 3%. That's how I would kind of think about it. And my my really, really honest advice is start with investing with someone who already knows how to invest. So if you want to eventually invest in startups, that's awesome. Like I highly encourage that. And put money with a venture capital firm first that you have heard really good things of, because now that they're managing your money, you can actually just ask them to teach you. Like for example, I've run a fund, and we have a lot of investors. And anytime my investors give me a call, guess what? I answer the phone. I have to. They give me money. And I'm teaching them how to invest if they want to learn, right? So I would say, hey, take advantage of that. If you're just getting started in alternatives, put your money with someone who's done it for a number of years, or you believe has a credible right to win because of being close as an investor or whatever it is. Give them a little bit of money and kind of abuse that. Like, use the time. Like, call them whenever you want and get all the information that you need just to dip your toe into the water. So start with a professional money manager, and then if you still want to, you can invest yourself. And maybe the last thing I'll say is, totally agree with what you said about what's happening in the macro. And the risk with alternatives is picking. The average private equity fund, you would have been better off investing in the stock market. The average. I don't know about real estate, I think it's about similar maybe. You gotta be looking at top quartile of fund managers, or decile if you're investing in hedge funds, even worse. Like you gotta be really good to outperform on alternatives if the person is like the stock market. So make sure that it's people that you really trust, because I agree that the returns are probably going to be lower in the kind of post market, but the risk of like doing one really bad real estate deal is like a lot worse than a couple years in the stock market. So that's my last piece of encouragement.
Perfect. I think that's a great place to move on to questions. With that, we'll open it up, and we got quite a few minutes here. So time for a few questions. What do you all want to ask these experts while we have them?
Well, we crushed that. Okay, no questions.
Well, I hadn't thought about inflation when we talk about. I mean, in some cases, like real estate, it's obvious that inflation actually could help, but how that impacts those investments.
What investments are an inflation hedge?
Right.
What are correlated risks with inflation? Absolutely an important element.
Well, I'd say commodities are a beneficiary of inflationary environments, so that is one way to get a hedge. And but you kind of have to have a sense as to where you are in the commodity price cycle. You wouldn't want to go in at a peak and think that that's just going to get better. But generally, that buying stuff is a better thing. And so a piece of property, I kind of view operating companies in the same way, because if they're invested in something that is it's a real activity. I think that's a hedge.
I think one thing that I would consider in that question is also how inflation relates to, and sometimes it's inverse, cost of capital, and then subsequently how the cost of capital affects the performance of these investments, i.e. if inflation goes up, there's certain immediate elements to that, primary impacts. There's also the impact of what happens if that forces the Fed rate down, forcing interest rates down. What does that do? And a secondary impact to debt-heavy oriented investments. There's kind of multi layers of impact there that are, even though it's a secondary effect, pretty predictable.
Yeah, I think hard asset inflation in the debt environment that we're in, you know, we've got a portfolio of almost 20 deals now, whether that's an office building or an apartment building. I think, you know, on the office side, a lot of our leases, their rental rate increases happen to be tied to CPI. That's inherently a hedge right there. But the asset inflation itself, you know, while that may be good for existing assets in the portfolio, there's still a tremendous difference between bid and ask, between a buyer and a seller. And when debt moves as quickly as it does, and with how Wall Street and a lot of other larger institutions kind of value that cost of capital, it doesn't give a whole lot of time for cap rates to catch up. And whether the Fed's got rates at 10% or 0%, if they move quickly, the seller may think it's a 6 cap and the buyer's like, I can't make the debt work going in. So if you can find cash flowing deals now where the debt terms make sense and it's not over levered, I think that's one of the best hedges along with the commodities. Or a service type company that can increase based on CPI or whatever it is on shorter term contracts. You know, I think right now if you're in a subscription based model with large companies and you've got 3 to 5 year contracts, especially if it's related to anything where you're stuck and they don't have any bumps, that's not the
You
best.
just have to understand what that risk element is.
Yeah,
Yeah.
but if it's month to month, I think you're much better off because you can adjust accordingly.
So we're sitting here right at 3 o'clock. Of course, feel free to leave if you need to. I think unless anyone has any other pressing questions, we're all going to hang out. Oh, question? Yes.
For Eduardo, I know we talked about a little bit about it. When you look at companies to acquire, I know you look at the owner. Once you acquire them, how much do you spend with developing the team that owner has? And then how does that become even a multiple factor when you exit?
Yeah, that's a good question. So in general, in private equity, there's kind of 2 kinds of private equity. There's the hiring side, and there's the firing side. It depends on what you're looking at. The bigger you are, the more you're probably talking about firing people. For us, and for if you're looking at small companies, which kind of focus, it's very much a part of one of the underwriting assessment. Like if there's no good management, we're going to pay less for it. We're going to have to hire or upgrade. If it's really strong, we pay more for it. But ultimately, we're kind of in the growth business, not in the cutting business. So to your point, it's quite important to assess the depth of the leadership team. And then in the best case scenario, we try to keep everyone, right? So we try to keep them and grow them so that they can be, that controller becomes a CFO at the next level. But if not, we'll obviously hire.
So let me wrap up the public question and maybe public session with this. There's a ton of information. Like I said, if you're interested in the longer reference guide that these guys have helped create and review, let us know. We'll get that to you. If you signed up for the event ahead of time, we'll probably just go ahead and send that to that group. If you don't want it, of course, you can get rid of it, but I think it's a good reference guide that covers all the vocabulary and frameworks that were discussed here. If you didn't, just let us know. We'd be happy to get that to you, or send us a note via the QR code. Make sure to grab the cheat sheet on the way out. One element that sticks out, and you'll see it in the guide, I think it's worth mentioning, there's a lot of complexity to these deals. It's all about selection. With that said, don't spend so much that you ruin your basis, because basis is important, but it's probably worthwhile hiring an expert to review that deal for you. Spend a little bit of money to augment your own skill set. Instead of reading OM, you went to 1 hour and a half presentation where some guys talked about one of those types of deals for 20 of those minutes and write a $100,000 check. It's probably worth, go ahead and paying a petroleum engineer a little bit of time to, for $100 an hour to review that thing for you, or a seasoned real estate investor or someone, pay some money to get some expert advice or opinions to augment your own skill set. And I think it will be well rewarded for it. So with that said, I think we will all hang out here for a little while. Feel free to come up, ask any questions you have. These guys are happy to give out their contact information for follow-up questions as well. Grab your cheat sheet on the way out. And thank you so much for your time, for your questions, and hope to get a chance to talk with all of you